Yo, what's up, everybody? Happy New Year 2023. Here we go. Recession, 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 recession. That's all we've been hearing. This is the year, folks. All the very smart people are saying recession in 2023. It's only little old me saying that's not going to happen. So we'll see. It's me against everybody, really. So today, I'll get to the market in a minute, but today the Atlanta Fed once again revised up its growth forecast for the fourth quarter, now 3.91%. That's really good growth, and that's like the third revision higher. Okay? And so we're supposed to believe, just think about this, because we had what, 3% or 3.2% growth in the third quarter, and now 3.91. So we had the first two quarters, the first half of 2022 last year, we saw a contraction, a minor contraction. Then we popped into growth as I forecast. If you go back and to my older videos prior to the beginning of the third quarter, I said that's going to be positive growth. Everybody was very, very negative at that time. I said fourth quarter was going to be positive growth. We're already at an estimate of 3.91, almost 4%. Okay, now just keep in mind that the average GDP growth for the United States, like over the last 30 years, has been like 2.5 to 3.5%. And don't forget, in 2022, the year just concluded, we came off a year of an historic contraction in fiscal support. All right, there were the media and the White House, and everybody was cheering that. Oh, look, we cut the deficit, but that was like almost a $2 trillion. I've been through this so many times. A $2 trillion takeaway, drain, subtraction from the financial balances of the economy. That's us. Like, they're all cheering that. But like, that's why we're all like, hey man, I think that's why everyone's thinking there's going to be a recession. But anyway, I said we were going to recover in the third quarter. I said we were going to recover in the fourth quarter, and that's what's happening. But now we're asked to believe that suddenly, out of nowhere, this year, there's going to be a huge collapse in the economy. All right? So let's think about this for a second. We're seeing sequential economic growth, okay, growth sequentially, and we also know the following. Number one, let's deal with the monetarist elephant in the room, which is Fed policy and interest rates. That all the zombie, insane, psycho monetarists, that's all they look at. Well, we know that the Fed is slowing its pace of rate increases. All right, we're going to get a rate increase in February. I think that's only going to be like 25 basis points based on where Fed fund futures are trading. And I say, like, the Fed just always follows that. They just always follow that. Like, why do you need a Fed? It's just like, if they're going to follow the market. I mean, I've said in the past, like, imagine John Rockefeller, Standard Oil, going around to all his little, competitors saying, well, what price should I price my oil? No, he crushed them. He took them out of business. He said, either you sell me your companies for my shares, or I'm going to run you out of business. So the Fed is slowing its rate of rate increases. We know this, right? What else do we know? We know that inflation is coming down. It's still elevated, but it's coming down. Okay? We know that there's going to be a big fiscal boost this year coming from an acceleration in these interest income transfers. And by the way, we're up to like the first 3 months of the fiscal year 2023, we're up to like 60 billion additional interest income injected into the economy. So we have that. We have the big increase in Social Security that's happening like as I speak, basically this year, the start of this year. Okay, that's going to be like another 100 billion. We have that 1.7 trillion spending bill that was just signed at the end of the year by Biden, and that has increases in military, of course, money for Ukraine. Why not? Give them another 50 billion. And other expenditures, other increases in expenditures there. We have the easing of supply chain issues, okay? So, I'm seeing like a lot of positive developments on the horizon. We're at almost 4% economic growth in the fourth quarter, but we're being told that we should expect some kind of crash in the economy. For what reason, I really don't know. Now, I could be missing out on something, but, I try to put all the facts out there. I try to give it to you as I see it, so to speak. Let me shift over here. All right, let's talk about the market. So today, again, the monetarist zombies, maybe they saw this revision higher in the GDP by the Atlanta Fed, and, we came in strong. They knocked it down. They want to sell it every day. It's pretty incredible. It's such a deeply embedded negativity that you have to imagine that when this thing turns, it's going to be like, it's just going to be like a massive explosion to the upside, because all of this negativity is going to be unwound. And I think it's going to be unwound slowly at first, like a fuse, like you light a fuse and a fuse is burning, and then nobody's really paying attention, and it's burning and it's burning, and then it just gets hotter and hotter, and then kaboom, will be a lot higher, and things will really start going wild. At that point, you're going to come to this channel, you're going to hear me saying, sell stocks, but we're a long way from that. So they try to sell it, and again, we saw this pattern like we saw on Friday, where the market dipped down, and then we had a recovery late in the day. I think the Dow was only down about 10 points, the S&P down, that's I think around 7, and NASDAQ still struggling a little bit. But those stocks tend to be much more highly leveraged, and so they go way up on the upside, and they go way down on the downside. We see that at every cycle. I'm not worried about that. Like I say all the time, I focus on basic economic conditions, all right? And I've laid out for you a number of times, I just did again. The reasons why I think this year is going to be positive, okay? I just gave you 4 reasons right there with the Fed slowing the rate hikes, and the rate hikes to me, I look at them anyway as a positive. I don't look at them like through the monetarist lens of, oh my God, this is terrible, this is horrible. The other thing is QT. That's another thing that they're leaning on, or another thing that they're pointing to as a negative for the economy. They see that as draining out liquidity, okay? Where, again, the only thing that QT really is, it's a recomposition or a change in the composition of financial assets in the economy. You have less reserves and more government securities, which are basically the same as reserves, except for the fact that they have a term, meaning a length, and a coupon, meaning an interest payment attached. And reserves earn interest too, but government securities earn higher interest. So this argument is an argument that comes from a lack of understanding, and I totally discount it. As a matter of fact, I went back and I looked today at a chart. We had a very significant decline in bank reserves from 2015 to 2020, okay? Where bank reserves dropped like 55%. Huge. We went from like 2.8 trillion to 1.3 trillion, all right? Yet the S&P, the stock market, the S&P doubled in that time. It was up 100%. Here's a chart. You can see it. So, the fears, at least for me, are totally ungrounded. They reflect ignorance for my part. I mean, the way I see it. I mean, they're just like, this is kind of like a story that they want to tell. It's a story that they want to believe in. And I mean, it's very, very noticeable because like every time the stock market starts to do well and gain some traction, you could see the commentary out there. The commentary is all over. It's like, what are people doing? Don't they understand that the Fed is going to be draining liquidity? And I even see some of these, you know, so-called very smart people like on Twitter, they're saying our only hope is if the Fed drains out the reverse repo facility. They need to empty that out to put the liquidity back into the, I mean, that would crash. If you drained out the RRP right now, 2.5, 2.6 trillion, like tomorrow, it would create another Lehman moment. It would crash. I mean, the banks would basically become instantaneously insolvent because dumping all those assets on their books without adding to their capital would put them in violation of, I mean, many different regulatory measures. Most, I mean, specifically the supplemental leverage ratio. All right, but this is like the very smart people. They're saying that's our only chance. That's our only hope. If they just drain out the reverse repo facility, it's crazy, man. It's crazy. I mean, if you go back to the 2008, to the Lehman crisis, it's exactly what precipitated that crisis. Well, not solely that. I mean, there was the fact that, you know, the government ran the deficit down way low. We got down to like 1.2% of GDP. And at that time, you know, if you're worried about debt and you hear all these stories about debt, and I've said this and I've shown this many times, that household debt burdens back in 2007 were at an all-time record high. It was at like 13.7% of disposable income. And now it's like even with the rate hikes, it's like 9.4% of disposable income. So the debt burden, in other words, the difficulty in serving the debt is down like, what is that, like 40%? All right, 30%, 40% from where it was in 2007. In other words, despite the rate hikes that we've seen so far, it's easier to service the debt now than it was back in 2007. So you had a combination of things happen in 2007. You had the government like almost balance its budget. You had a credit structure that was very shaky based on the amount of debt to disposable income. All right? Right now, we don't have that. I mean, they're still running. We're going to run easy, you know, over $1 trillion. We'll run like a 5% something of GDP deficit this year. Okay? That's down big from 10% over the last 2 years or whatever, but it's not like 1%. Okay? And we got the debt structure is a lot more manageable now, because people talk about the debt in nominal terms, like, oh my God, it's this trillions or these trillions. It's about servicing the debt. I mean, if you make your payments every month, like, nobody's going to come after you. And no institution is going to be in trouble. It's when you can't make the payments. And you can't make the payments when you lose your income, or when the payments become a true burden, again, based on your income. And we just don't have that scenario right now. If we did, I would tell you, but we just don't have that scenario right now. So I'm not trying to be Pollyanna, like everything's wonderful now. Like, I'm a little bit actually concerned about the job report on Friday, because I'm starting to see a pickup in average daily unemployment benefits that are being paid out. It's still really, really, really low, but I mean, it is trending higher. I think it's the highest now since like October 12th, and that October 12th it spiked up because of Hurricane Ian that was a temporary thing, and then it came back down again. But now it's trending back up to that level. So we could see a weak job report on Friday, and maybe that would change the outlook a little bit. Not for me. It's not going to change the outlook. As long as I see, that fiscal at a high enough level, and those income transfers at a high enough level, what happens is the economy just kind of recomposes itself. It's just like some other sectors are going to take, like we've seen a lot of these cuts in the tech sector, but we're seeing activity in, banks are doing well. JP Morgan's up 33% from the lows in October. BlackRock is up 40%. Because I guess maybe they made a deal with Zelensky to rebuild Ukraine, right? Fink, what's his name? Made some kind of a deal with Zelensky. Not surprised. So anyway, that's the outlook. You got to buy the dips. We still need, I think today, when we get the data tomorrow, I think finally that all of that December tax train, because, I didn't mention this. I forgot to mention this, but we did not see the full, I said we were going to get on Friday the full first of the month payments, 92, 95 billion. For some reason, we didn't get all of them. We got like 39.7 billion. I was surprised because usually, if it's a calendar situation where the first of the month falls on a Saturday or a Sunday or a holiday, it comes out on the first or the last business day prior to, the holiday or the weekend. It didn't. It went only 39.7 billion came out. So I'm expecting to see in the data tomorrow another, 55 billion or something that was paid out today. So tomorrow should be a good day in the market. That's it for today, everybody. Let's go, go, go. 2023. Right on. See you tomorrow. Bye.